The market was not just rising, it was accelerating into a belief that nothing could go wrong. Home prices kept climbing, and with every increase, confidence quietly turned into certainty. Banks were not just lending money, they were expanding risk across the entire system. Mortgages were no longer about ownership. They had become financial instruments. Wall Street was thriving, fueled by leverage that few truly understood. Every approved loan looked like growth, even when the foundation was already weakening.
Risk was not removed. It was simply moved, hidden, and repackaged across the system.
Complex securities transformed fragile loans into products that appeared stable. Ratings created an illusion of safety, masking the reality beneath the surface. Confidence reached its highest point at the exact moment the system became most fragile.
The higher the market climbed, the less attention was paid to what was happening underneath. Institutions trusted their models more than reality, and that trust became dangerous.
Behind the growth, many borrowers were already struggling to keep up with payments.
Defaults were rising quietly, too slowly to trigger panic, but too consistently to ignore.
Everything still appeared stable, but the system was already under pressure.
The system depended on continuous growth, and even a slight slowdown began to expose its weakness.
Subprime borrowers were no longer keeping up, and the pressure was starting to spread.
Defaults were rising steadily, not fast enough to shock, but too consistent to ignore.
Warnings were present, but they were inconvenient and easier to dismiss than to confront.
The structure had become too complex to understand and too profitable to question. Liquidity was no longer abundant, and the system began to feel the first signs of pressure.
Short-term funding started to tighten, and institutions quietly began to pull back.
The system looked diversified, but in reality, everything was deeply connected. Confidence was still present, but it was no longer as strong as before.
The market had not broken yet, but it was no longer stable.
The first signs of failure did not appear dramatic, but they were impossible to ignore.
Defaults began to accelerate, and the system struggled to absorb the impact.
Assets once considered safe were suddenly questioned, and their value began to change. Trust between institutions began to weaken, and lending slowed dramatically. The market shifted from confidence to uncertainty, and hesitation began to spread.
Selling pressure began to build, not from panic, but from necessity. Positions were no longer strategic. They were being closed to survive.
Funding sources tightened further, and institutions struggled to maintain liquidity.
Confidence was no longer stable. It was beginning to fracture under pressure.
What started as isolated stress was now spreading across the entire system.
The market was no longer reacting. It was starting to panic. Selling accelerated as fear replaced hesitation across the system.
Liquidity disappeared faster than anyone expected, leaving no room to react.
Credit markets began to freeze, and the system started to lock up.
At this point, the system was no longer in control of itself.
Then came the moment that defined the crisis. Lehman Brothers collapsed.
The failure was not just a company. It was a signal that the system could fail.
Trust collapsed instantly, and without trust, the system could not function. The shock spread globally, faster than any previous financial event. At that moment, panic was no longer a risk. It had become reality.
The market entered freefall, and there was no clear bottom in sight.
Positions were liquidated across the board, not by choice, but by force.
Margin calls spread rapidly, forcing even strong positions to be sold.
The system began feeding on itself, where every drop triggered another.
At this stage, stability no longer existed. Only survival remained.
The crisis moved beyond markets and into the lives of ordinary people.
Homes were lost, not because people chose to leave, but because they could not stay.
Jobs disappeared rapidly as companies struggled to survive the collapse. Entire communities felt the shock as the effects spread beyond finance.
Wealth was erased in months. What took years to build disappeared almost instantly.
As the system collapsed, governments were forced to step in to prevent total failure.
Central banks moved quickly, injecting liquidity to stabilize the collapsing system.
Major institutions were rescued, not because they were strong, but because they were essential.
Public trust was shaken as the system was saved, but not without consequence.
The collapse slowed, but the damage had already been done.
The market began to stabilize, but the recovery was fragile and uncertain.
Confidence did not return quickly. It had been deeply damaged. The economy moved forward, but at a pace far slower than before.
The impact of the crisis remained long after the market stopped falling.
The system survived, but it was no longer the same.
The crisis was not a single failure. It was a chain of decisions that built upon each other. The system did not collapse because of one mistake, but because of its design.
At its core, the crisis was driven not just by systems, but by human behavior.
Markets move in cycles, but the patterns are often ignored until it is too late.
Risk does not disappear. It only changes form and waits to be rediscovered.
The system recovered, but the memory of its failure never fully disappeared.
Things. What was lost was not only wealth, but trust in how the system truly worked.
Even as markets moved forward, the structure carried the scars of the collapse. Because in every recovery, the conditions for the next cycle quietly begin again.
The system did not fail by accident. It failed exactly as it was built.